Warren Buffett founded his investment business when he was barely 25 years old. Buffett Partnership Limited was the name he gave it. From 1957 to 1969, this investment business operated, and during that time, Buffett achieved an average yearly return of 29.5%. And what's noteworthy about Warren Buffett's approach to investing is that he achieves these tremendous returns by employing relatively simple approaches. You don't have to be a rocket scientist, Buffett adds. Investing is not a game in which a person with 160 IQ outperforms the person with 130 IQ. Rationality is necessary. So being reasonable and implementing simple techniques and sticking to them when things are tough is the key to obtaining great returns. For today's video, I'm going to show you 7 investment rules that Warren Buffett employed to help him reach such a high rate of return. But first, if this is your first visit to our Smart Stocks Academy channel, please accept my best greetings. And to be the first to know when a new video like this is released, hit the like button, subscribe, and click the notification bell next to it. So, let's get to the video. First of all, I am not claiming that you'll make as much money as Warren Buffett. He is a highly intelligent individual who has committed his life to investment. Nonetheless, following his 7 investing guidelines will significantly improve your total long-term performance. So, when Warren Buffett first opened up one of the best investment books of all time, he learned this principle. Benjamin Graham, who subsequently became Buffett's mentor, is known as the author of The Intelligent Investor. One of the principles outlined in the book, however, was actually rather easy. Buffett was persuaded by the idea that when you hold a stock, you own a portion of the company. And if their business does well in the long run, the stocks will do well as well. So keep an eye out for the firms that will rule in the future. It is a business with a large profit margin, the one who is a step ahead of the pack, and it's the one that their customers like. Guys, you don't need things to be difficult. A stock is a component of a business, and if their firm succeeds, so will yours. Buffett's stance may be controversial. However, most news you read is not essential when it comes to investing. The fact is, news organizations such as CNBC, news websites, and financial YouTubers are all compensated to acquire as many views as possible. So what they do is generate as much excitement or suspense as possible, as well as much more news as possible, in order to obtain those views and so get compensated more. Just need to give importance to roughly 5% of that information. Owner of stocks, on the other hand, all too frequently allow their fellow owners' unpredictable and often illogical conduct to drive them to behave irrationally as well, Buffett adds. Because there is so much talk about markets, the economy, interest rates, stock price behavior, and so on, some investors feel that it is vital to pay attention to influencers, and worse, contemplate acting on their advice. Don't be concerned about the pundits, and don't be concerned about the majority of the news. Pay attention to the most crucial aspects, and that's all there is to it. Now, I'm hoping that this is a financial theory you've learned previously. The potential of compound interests is enormous. You can make a lot of money if you obtain dividends or capital gains and let them compound and develop like a snowball. However, if you frequently purchase and sell stocks, you are not allowing compound interest to work for you, and you will miss out on a lot of gains, just like this line. It's all about the time in the market, not timing the market, they argue. So, when it comes to investing, the goal is to acquire a stock with the intention of owning it for the rest of your life. That is why For over 25 years, Buffett has held equities like Coca-Cola, Wells Fargo, and American Express. If the work is done well when a common stock is acquired, the grateful fisher continues, the moment to sell is almost never. Even Warren Buffett has spent his whole investment career having to learn from and listening to other traders. He had an investment mentor, Benjamin Graham, when he was a youngster, who taught him the basics of investing. When he was a little older, he always had Charlie Munger at his side to make sure he was on the correct track. We're also fortunate in that we have fantastic investors to listen to and learn from, and it's unmistakably Warren Buffett. We can examine the specific equities he purchased each year as well as his total portfolio. Ray Dalio is another example. He is a frequent guest on CNBC where he expresses his thoughts on a variety of topics. Charlie Munger is the same way. However, we must pay attention to those we know and trust. Do we have to listen to that CNBC commentator who is always spouting off about the newest hype? Or the new YouTuber with a lot of followers who is raving about Tesla stock? Do they actually know what they're doing when it comes to investing? Do they have a thorough understanding of each stock's intrinsic value? Only those you know and trust should be listened to. Understand the company that you're investing in is a basic guideline that not many people follow. If we look at Warren Buffett's investment, one thing that stands out is that many of the firms he owns are essentially rather basic. He owns the Coca-Cola Corporation. They started off selling soft drinks and have now grown to include cuisines. Southwest Airlines is a commercial airline that earns money by selling flights. Furniture Mart is a store that sells furniture. Apple is a company that sells iPhones and other electronic devices. Before buying a stock, Warren Buffett ensures that he has a thorough grasp of the firm, and you should do the same. If you're interested in vehicles, take a closer look at Ford, Toyota, and Tesla. If you're into e-commerce, you should be familiar with Amazon and Alibaba. Look at firms like Alphabet, which owns Google and YouTube, if you enjoy the internet. There are stocks available to buy for almost any hobby or interest. Only invest in firms that you have a good grasp of. This is a guideline that is especially applicable in today's economy. The difficulty with the present market conditions is that we've been in a bull market for around 11 years. And when it comes to the stock market, everyone believes they're geniuses since everything has been going up and everyone is making money. As a result, one clear conclusion may be drawn. Because they are overconfident in their investment abilities, everyone gets greedy. What effects do you believe that this has on stock prices now? Well, it artificially inflates prices. Everyone wants to invest, but as stock prices rise, it becomes increasingly difficult to locate a bargain in the stock market. These are the moments when we need to be afraid and cautious with our investments. And Buffett is doing precisely that. He owns $128 billion in cash and $214 billion in publicly listed equities. That is a substantial sum of money in cash. And in these market conditions, he is now taking a very cautious technique. He has been apprehensive, to say the least. But you can bet your sweet dollar that as immediately a stock market panic sets in, Warren Buffett's appetite will step in and he'll be buying up a lot of shares while they're on a bargain. When it comes to investing, if you don't follow this rule, all of the other rules will be thrown out the window, and your investment plan would be meaningless. It is not worth an endless price, no matter how wonderful the firm is, how skilled the management, or how well you understand the company. You must also ensure that the amount you are paying for is below or equal to the inherent worth of the item. Please allow me to explain this a bit more thoroughly. Assume you're considering purchasing a Ferrari. There is no doubt in anyone's mind that this is a fantastic vehicle. There is very little doubt that designers spent a great deal of time and effort constructing this vehicle. But there is one question you must ask. Is it worth the price? Is it really worth the $350,000? Remember that no automobile is worth an endless amount of money, and the same is true for business stocks. As a result, Warren Buffett believes that no firm, no matter how great, is worth an unlimited price. What you pay is what you get. What you get is what you pay for. Therefore, you must first learn how to compute the intrinsic value of each stock is before you can determine its worth. As a result, I'd recommend attending Sven Carlin's free investing course. He is a reputable investor. He is also providing a complete guidance on how to invest in this course. And of course, how to assess equities and determine their intrinsic worth is discussed. You may learn more about this course by clicking on the link below, or you can look at his portfolio of stocks that he's buying on his research platform. If you're seeking for strong long-term profits, it is absolutely worth the money. Nonetheless, these 7 guidelines are crucial when it comes to investing, in my own opinion. You must have the perspective that a stock is a component of a business, and that if their firm succeeds, so will yours. Most of the news on those financial TV shows and most YouTubers is just noise, not news. So when purchasing a stock, the optimal holding term is indefinite. Never invest in a firm that you do not understand. When others are greedy, be afraid. And when others are terrified, be greedy. And of course, only buy a stock at reasonable prices. If you follow these 7 guidelines, you'll be able to outsmart the majority of investors. And with that, we come to the end of today's video. To express your love and support for today's video, hit the like button, subscribe, and click the notification bell next to it to be the first to know when we have a new video. I hope you enjoyed it, and we look forward to seeing you on our next video.